Something historic just happened in the silver market and almost no one was paying attention. While Western traders were offline, while markets were closed and headlines were quiet, the real market made its move. Physical silver in retail shops across China traded near $91 per ounce. Not estimates, not projections, real metal, real buyers, real transactions taking place in the physical world. At the exact same time, the paper market, the one that claims to set the global price of silver, was still sitting near $79.59. Two prices for one metal. One price where silver actually changes hands, another where contracts trade on screens. An $11-plus gap that is far too large to dismiss as noise or a temporary premium. This is not normal behavior, this is not a rounding error, and it is not something that quietly fixes itself. When physical and paper prices diverge this sharply in a critical commodity, it signals stress beneath the surface. It means the price you see may no longer reflect the price you must pay. And once that realization spreads, markets change fast. Let me be clear before we go further. This is not financial advice. I'm not telling you what to buy or sell. I am laying out facts, mechanics, and historical patterns so you can make informed decisions. You are responsible for your own risk. For decades, the paper price led. Miners followed it. Manufacturers referenced it. Investors trusted it. But when physical silver clears at $91 while paper insists it is under $80, authority begins to crack. Confidence shifts. And once market participants stop trusting, the screen control weakens rapidly. When Western markets reopen, this gap cannot remain. It will be forced to resolve. Either paper prices surge upward to chase physical reality, or paper attempts to crush the price to defend its narrative. Both outcomes involve volatility, both involve pain, and where you are positioned when that happens matters more than your opinion. This is the $91 silver shock, the moment reality printed quietly while most of the world was asleep. And Monday morning may force the silver market to answer a question it has avoided for years: which price is real? If you want analysis like this as it unfolds, subscribe and turn on notifications. Now comment using numbers only. 1. I own silver. 2. I am watching from the sidelines. To understand why the $91 silver price in China matters, we need to dismantle a dangerous myth. Many people immediately say that is just retail. Retail always has premiums. The real market is paper. That assumption sounds logical, and it is exactly why so many miss major turning points. Retail is where physical stress shows up first. Retail pricing follows one unforgiving rule: when metal is scarce and buyers are urgent, prices adjust instantly. There is no leverage, no rolling contracts, no delay. Either the dealer has silver available or they do not. And when supply is tight, the price rises until only the most motivated buyer remains. That is pure supply and demand stripped of financial engineering. Paper markets are different. They can postpone reality. They create synthetic supply. They cash settle instead of delivering metal. They preserve confidence even when physical availability is quietly disappearing. Retail cannot hide shortages. Retail is pay now, receive metal now, or leave empty-handed. Here is the part most analysts ignore. Retail prices do not stay isolated. They flow backward through the entire supply chain. If silver clears at $91 at the shop level, wholesalers must raise prices. Refiners follow. Eventually, miners demand more. Retail sets the floor because it reflects what silver is worth when delivery actually matters. There is also a psychological shift. When buyers see $79 on a screen but are quoted $91 in reality, trust breaks. They stop believing the screen and start believing availability. That is how price authority begins to move. China magnifies this signal. This is not casual speculation. China manufactures the world's solar panels, electronics, and electric vehicles, all silver-intensive industries. When prices rise there, it reflects urgent, non-negotiable demand. Factories do not wait for pullbacks. They secure supply. That is why the $91 price is not noise. It is where reality leaks out first. Now, we need to talk about structure, because this is where most people finally understand why the paper-silver market becomes fragile when physical tightness appears. The problem is not manipulation in the cartoon sense. The problem is leverage and assumptions. The paper-silver market is built on futures contracts. Each contract represents 5,000 ounces of silver, but very few participants ever intend to receive metal. Most trades are closed, rolled forward, or cash settled. Only a tiny percentage of contracts result in physical delivery. As long as that remains true, the system functions smoothly. But that smooth operation depends on two critical assumptions. First, that physical demand stays calm. Second, that confidence remains intact. As long as traders believe metal will be available if needed, no one rushes to test the system. Here is where the vulnerability appears. To control a contract worth hundreds of thousands of dollars in silver, traders post only a fraction of that value as margin. That means the paper market represents far more silver than actually exists in deliverable form. On many occasions, open interest has exceeded 900 million ounces, while registered inventory sits below 70 million ounces. That is more than 10 paper claims for every physical ounce. This leverage works until people want metal instead of exposure. If physical demand stays low, no issue. But when buyers see a massive gap between physical and paper prices, incentives change. Suddenly, delivery matters, and if too many participants demand physical settlement at the same time, the math breaks. The exchange does not have enough metal to meet those claims. This is why textbook arbitrage often fails in real shortages. In theory, traders should buy paper silver, take delivery, ship it, and sell at the higher physical price. In reality, delivery windows, logistics approvals, and inventory constraints make that slow and risky. And the more people try to pull metal out, the more stressed the system becomes. Instead of closing the gap, arbitrage exposes it. Inventories drain, premiums rise, confidence erodes. The paper market can still trade, but its authority weakens. And once participants realize paper prices no longer guarantee access to metal, the system becomes unstable. That is when markets stop moving in steps and start moving in jumps. To understand why this divergence can grow instead of shrink, you need to understand silver as a supply chain metal, not just an investment. Silver demand is not driven by sentiment alone. It is driven by necessity. And necessity does not pause when prices rise. Start with solar. Modern solar panels rely on silver paste to conduct electricity efficiently. There is no true substitute that preserves performance at scale. As countries push aggressive renewable targets, global solar installations keep accelerating. And newer panel technologies use more silver per unit, not less. As the industry upgrades, silver consumption increases even faster. Then comes electrification. Vehicles, homes, transportation, and infrastructure are all moving toward electric systems. Every additional circuit connector and power component requires silver because it is the most efficient conductor available. As electrification expands, silver demand compounds. Electric vehicles illustrate this perfectly. A traditional vehicle uses modest amounts of silver. An EV uses significantly more. And next-generation battery technologies could multiply that usage again. Even at much higher silver prices, the cost impact on a finished vehicle is small relative to the total price. Manufacturers do not stop production because silver is expensive. They pass the cost along and keep building. Electronics add another layer. Smartphones, computers, appliances, data centers all depend on silver. The global push into AI and cloud infrastructure is creating enormous new demand for power, wiring, and cooling systems, all of which consume silver. These projects do not wait for price dips. They secure a supply or risk failure. Silver is also critical in medicine and defense. Its antimicrobial properties make it essential in healthcare equipment. Military systems rely on it for reliability and performance. These sectors do not negotiate with markets. They acquire what they need. This is what makes silver demand inelastic. When prices rise, demand does not fall. It absorbs the increase. The only mechanism left to balance the market is higher prices. And because new mine supply takes years to develop, price becomes the rationing tool. That is why a $91 physical price is not extreme. It is early. Now we arrive at the critical moment, the point where theory ends and the market is forced to act. When Western markets reopen, the $11 gap between physical and paper silver cannot simply sit there. Markets hate contradictions. They resolve them. And this resolution is what I call the Monday trap. There are only two ways this can play out. The first path is paper chasing physical. The paper price gaps higher at the open trying to catch up to the reality printed in the physical market. Shorts who sold silver in the high 70s suddenly find themselves underwater. Margin calls begin. Some are forced to cover. That forced buying pushes price higher, triggering stop-loss orders from other short positions. Those stops become market buys. Momentum builds. Algorithms detect this breakout and join the move. Liquidity thins. Price stops moving in steps and starts jumping. What should have been a slow adjustment over weeks compresses into hours. This is how suppressed pressure releases. Not smoothly, but violently. The second path is paper attempting to crush the signal. Heavy sell programs hit the open. Large players dump futures contracts to push the screen price down and restore confidence in the paper reference. Headlines follow. Silver drops. China premium fades. The goal is psychological. Convince participants that the physical price was an anomaly and paper is still in control. But this path only works if physical demand retreats. If Chinese buyers continue paying near $91 after a paper smash, the gap doesn't close. It widens, and a wider gap proves the smash failed. It proves physical demand is real, urgent, and indifferent to paper theatrics. When that happens, price often rebounds harder than before because weak hands are gone and strong hands remain. This is why leverage becomes dangerous here. Even if your long-term thesis is correct, volatility can remove you from the game before it plays out. Structural transitions punish impatience. Monday is not about being right. It's about surviving the resolution. This is the phase where many traders make their most expensive mistakes. Not because their thesis is wrong, but because their positioning is. Structural transitions expose the weakness of leverage faster than anything else in markets. Leverage works beautifully in stable systems, when volatility is contained, when price discovery is orderly, when the rules of the game are respected. But when physical reality starts challenging paper structure, volatility explodes. And leverage turns from a tool into a weapon aimed at the trader. In a leveraged position, timing matters more than direction. You can be correct about silver's long-term shortage, correct about industrial demand, correct about the paper market's vulnerability, and still lose everything if price moves violently against you for a short window. A sudden $4 or $5 swing can trigger margin calls, force liquidations, and remove you from the market entirely. This is why structural breaks favor those who own the asset, not those who rent exposure to it. Physical holders don't face margin calls. They don't get stopped out by algorithmic spikes. They aren't forced to sell because of a temporary smash designed to shake confidence. They can wait. And in markets like this, patience is a strategic advantage. Leverage traders don't get that luxury. They are exposed to every tactic the paper market uses to defend itself. Sudden dumps, headline-driven fear, liquidity vacuums. These aren't designed to reflect fundamentals. They're designed to force exits. This is also where false confidence becomes dangerous. When markets are calm, traders mistake survival for skill. But when volatility arrives, only structure matters, and leverage structures are fragile by design. What's happening now is not a normal trading environment, it's a transition. Authority is being questioned, price discovery is shifting. And during these moments, markets don't reward precision, they reward resilience. If you are positioned in silver, the most important question isn't where price goes tomorrow. It's whether your position can survive the path it takes to get there. Because in transitions like this, the path is rarely smooth. Understanding the big picture is important, but markets are decided in real time. When price starts moving, narratives collapse quickly. That's why this chapter matters. These are the signals that tell you which side is winning as the market resolves the gap. The first signal is not the opening spike, it's whether price can hold. If paper silver gaps higher and stays above key levels through the morning session, that's strength. Holding matters more than touching. A fast move up that immediately reverses tells you sellers are still in control. A grind higher with higher hourly closes tells you shorts are trapped. The second signal is physical premiums. Watch what happens in the real world while the screen moves. If dealers in China and other physical hubs continue quoting elevated prices, it confirms demand is real. Paper moves don't matter if physical buyers refuse to back down. If physical prices remain firm, while paper volatility increases, physical is leading. The third signal is how the gap closes. Does paper rise toward physical, or does physical fall toward paper? That distinction tells you everything. When paper chases physical, authority is shifting. When physical capitulates, paper retains control. Watch which side moves more. The fourth signal is stress in the supply chain. Reports of delivery delays, restricted allocations, or inventory drawdowns matter more than price ticks. These are confirmations of real shortage. When supply tightens, paper defenses weaken. Finally, watch volatility behavior. Violent swings that fail to break key levels suggest desperation. Calm upward movement suggests acceptance. Markets reveal intent through behavior, not commentary. Put these together and you can see the battle unfolding. This isn't a guessing game. The market tells you who's winning if you know what to watch. One of the most misunderstood moments in any commodity transition is the failed smash. On the surface, it looks bearish. Price drops sharply. Headlines turn negative. Confidence shakes. But structurally, a failed smash is often the most bullish signal the market can give. Here's why. When paper markets sense a loss of control, they respond with force. Large sell programs hit thin liquidity. Prices pushed lower quickly, not to reflect supply and demand, but to test conviction. The goal is simple: scare physical buyers, trigger stop losses, and reassert authority. If physical demand retreats, the strategy works. The narrative is restored. But when it doesn't work, everything changes. If price is smashed, and physical buyers keep paying elevated prices anyway, the attack backfires. The gap widens instead of closing. Paper loses credibility. Physical demand proves it is real, urgent, and price insensitive. That's when confidence migrates permanently. A failed smash also cleans the market. Weak hands are shaken out. Over-leveraged traders are forced to exit. Silver moves from speculative holders to strategic holders. That transfer matters because strong hands don't sell easily. They don't panic on volatility. They wait. After a failed smash of paper, markets face a dilemma. Every additional attack risks proving weakness. Every bounce attracts more buyers. And once participants realize that downward pressure no longer changes physical behavior, the only remaining adjustment mechanism is higher prices. This is why failed suppressions often precede explosive moves. The market tests the floor. The floor holds. And from that moment on, risk flips. Downside becomes limited. Upside becomes asymmetric. If you're watching this market unfold, don't just look at the size of the drop. Look at the response. Does physical pricing blink? Do buyers disappear? Or does demand remain firm while paper struggles? That answer tells you more than any chart. At this stage, the issue isn't whether silver is under stress. It's how to operate in a market that no longer moves politely. When physical reality starts challenging paper control, price behavior changes. First, explanations come later. This is where many people get trapped. Waiting for comfort. They wait for clean pullbacks, clear confirmation, or textbook setups. But structurally, tight markets don't offer patience. They move quickly, often before consensus forms. By the time clarity arrives, price has already adjusted. That creates risk for those sitting in cash. Waiting for the perfect entry can mean missing the repricing entirely. When paper prices are forced to catch up to physical pullbacks, tend to be shallow and brief. Hesitation becomes expensive. This environment is also brutal for shorts. The upside reward is limited, but the downside risk is enormous. A single repricing event can erase months of gains in minutes. Structural markets don't warn shorts. They overwhelm them. Physical holders face a different reality. Owning the asset removes timing pressure. There are no margin calls, no forced exits, no need to react to intraday noise. That flexibility becomes a strategic advantage when volatility spikes. The mindset matters most. This isn't about trading every move. It's about staying positioned without being forced out. Markets like this reward patience and punish leverage. As physical and paper converge, the market will decide who is prepared for reality. What's happening in the silver market is bigger than one volatile open or one dramatic headline. It's a lesson in how markets behave when old structures begin to crack. For decades, paper prices controlled perception while physical markets quietly followed. That hierarchy is now being tested. The $91 physical price in China isn't just a number. It's a warning signal. It reflects tightening availability, urgent demand, and rising consequences for delay. When physical markets start leading price discovery, paper markets eventually follow, and they never do it smoothly. The key lesson is this: structural shifts don't reward perfect timing. They reward durability. Traders who rely on leverage and precision are often removed before the real move begins. Those who reduce fragility and respect volatility last long enough to benefit. Patience matters. These moments are designed to exhaust confidence before rewarding conviction. False moves, fear-driven drops, and sudden reversals are part of the process. They are not signs the thesis is wrong. They are tests. Above all, remember, this price is not what a screen displays. Price is what someone must pay to take delivery, and when that price diverges from paper, claims resolution is unavoidable. If this perspective helped you, subscribe, like the video, and share it. Comment below using numbers only. 1 equals physical will lead. 2 equals paper will regain control. Stay alert. Stay prepared.